Welcome to the latest episode of the Ingot podcast, the IP Goldmine. I'm here today with James Andrews from Ingot, who is the head of financial and insurance markets here. Welcome, James.
Thank you, Ryan, and it's a very great pleasure to be here.
Great. So let's just get straight into it, shall we? So, James, when banks talk about risk, what are they really referring to?
Well, let's step back, Ryan, and think about this. Essentially, risk is uncertainty, and they're trying to quantify, when you talk about risk, you're trying to quantify the probability of a downside or an upside to doing something. Now, in lending, from the lender's perspective, there's no upside or further upside to doing lending. The loan either gets repaid or it doesn't, and that's binary. So obviously getting repaid is where you want to be. Not getting repaid is a downside. So not getting repaid essentially implies a payment default. Now, let's think about not getting repaid, the downside risk as you quantified it there. And the way we think about that, or the way bank thinks about that, is to split it into two elements. The probability of default, which I just said, which is binary. And then if it happens, the expected loss. So you don't get repaid, how much are you going to lose? I think that's the simple way of looking at it. And fundamentally, that's the basic building blocks of how it all works. All loan regulatory controls, things put in by regulators like the PRA and whatever else in other countries, are formulated around those 2 points. If you strip it back, that's how it works. So what happens with that? Okay, the banks will sit there and work out what that risk is. As I said just now, the probability of default multiplied by the loss if it happens. And to cover that, they charge a margin over their cost of funds. Their cost of funds is what it is. That's how much it costs them to borrow their money. That's pretty obvious, I know, but that's what it is. And they have their overheads to add on to that as part of the margin. They might have something called a term premium, which means just borrowing money for longer than 6 months. But most importantly, for what you just asked me, they have their regulatory capital cost, and that is really coming from the expected loss totally across the portfolio, not just from the one loan, but across the portfolio. So it has to cover the losses elsewhere in that portfolio. So their calculation of the forecast loss, risk, as you put it to me, is absolutely fundamental in terms of risk management and in their pricing.
That leads on to my next question then. So, why do intangible assets like IP historically make traditional lenders cautious?
Well, I have been a traditional lender in the past, in a previous life there, Ryan. So I can talk about this with some authority, I think. And in my view, it really stems from the accounting. And an apologies to any accountants watching this here, but the accounting, to use the sort of very broad term, is a little bit stuck, I think, in the 19th, maybe the 20th century in terms of how it looks at intangibles anyway. I'm sure it's fantastic in lots of other ways, but in intangibles, it hasn't really moved on yet. And essentially what accounting does, looks at everything, looks at assets anyway, as if they're tangible assets. Now, that's obviously from the days when we all used machines. Companies had machines and they bought them and they used them and they wore out. So you had a specific cost that you paid for that machine at the start, and then you had an expected life and you knew how long that was going to be, and you depreciated it every year until when you thought that expected life was going to end, it was then written down to zero. Nice and easily goes right down. Now, intangibles are a lot more, are a bit trickier to think about from an accounting term point of view than that, because first of all, you haven't necessarily got a cost to start with, because you probably developed it internally, and as we all know, internal costs are very hard to measure and all those sorts of things. So you've got that sort of, you haven't got a price because you haven't bought the thing, basically. There hasn't been an external transaction to give you that start price. And then the more you use them, if you think about it, the more valuable intangibles become. They don't wear out. If Microsoft sells one box of Windows, whatever, Windows 20, let's call it, that, or if it sells 1 billion boxes of Windows 20, you haven't worn it out. What you've done by selling that extra 1 billion boxes, you've made it far, far more valuable. Now, the accounting doesn't deal with that. At best, it sets a cost, which goes, this is even if it gets onto the balance sheet, intangibles I'm talking about. If it gets onto the balance sheet, there's a lot of rules around that. There has to be a high level of certainty it's going to earn money in the future, and so on and so forth. But if it gets onto the balance sheet, it goes on at cost, because that's all you've got to work with, as I said just now. There hasn't been an external transaction if it's been internally developed, I should have said. And then what happens when it gets onto the balance sheet? What happens is it gets depreciated in this view that it's going to wear out, because that's what tangible assets tend to do. As I said just now, that's not the case. The more you use it, the more its value goes up. The accounting can't deal with that. What a bank then sees when it looks at something, it sees a company that's a fairly young company that's growing, it's doing all the right things, it's investing money in its largely in its intangibles, frankly, because it should be investing in its innovation, and that's kind of intangible. What it's doing is it's seeing a whole lot of accumulated losses over the years since the company's been founded. And there's an entry for that, so you get a big negative number because it's had lots and lots and lots of losses each year, because it's been spending money on what it should be spending its money on. So it sees that, okay, but then it doesn't see any sort of offsetting asset because of the reasons I just said. It probably hasn't made it onto the balance sheet, and if it has, it's made it onto a very low number. So the bank looks at it and thinks, okay, this company's just been frittering money away. Essentially, I can't see anything to say what it's doing. So therefore, it must be a bad risk. And what I used to do, banks always used to do this, I know, because I used to do it myself, and I suspect a number of them still probably do this. They take a red pen and they strike through the intangibles. If they see anything in the balance sheet, they'll strike it through. Even worse than that, some of them will deduct it from the capital and reserves, which is a double whammy. So it's a double hit. So for having developed something, we show it at too small a price, and then we deduct it from capital and reserves. So the financials then look absolutely terrible. Why would we lend to this company? That's because we haven't understood the value that is actually there, that is driving the revenues that you're seeing at the top. It's as if it's coming out of some magic pot.
What are the most common misunderstandings about IP and risk then, from a
Well,
banking perspective?
sure. As I said just now, the accounting isn't helping. And what that tends to lead to is a thinking, well, the IP adds nothing. It's something that's on there. If we can't find it really, it's got no value. It's on there as a bit of a cost center. It doesn't really do anything. At worst, it may even be a liability. None of that is true if it's real IP, of course. For an innovative company, it's probably the only really material asset they have. Probably, obviously, companies are different and all the rest of it. But what else is on the balance sheet for an SME that's growth, that's got an innovation? There might be some cash on there. There may be some stock, depending on what it does. And there's almost certainly going to be some debtors. And that's going to be it. There's nothing really to grab onto. Companies don't own properties. They don't own fleets of cars. They don't own big machinery anymore, or very few of them do anyway. So that perception morphs into an idea then that the IP has no resale value, because, well, we don't show it on the balance sheet, or if we do, it's tuppence halfpenny, so to speak, to use the vernacular. So it's got no resale value if there's an insolvency, and we need to start realizing those assets and remembering the expected loss piece I talked about it. So, why should we be doing any of this? That's kind of the thinking and the pitfalls that happened. IP has no resale value. Well, no assets have real value in a fire sale. That's true, because by definition, a fire sale is flogging anything off very quickly for what you want to get for it. So if we ignore fire sales, because insolvency practitioners shouldn't be doing those, look at some recent bankruptcies. Go and have a look in the news stories or whatever you can find, and have a look at what gets bought. 9 times out of 10, it's things like brands, databases, trademarks, patents, that sort of stuff. It's generally not the stock or buildings. Well, perhaps the buildings will get bought, but they're going to be at a knockdown rate. If you look at the retail branches, Woolworths, Debenhams, the big famous ones, properties didn't get bought. It was the brands, it was the trademarks, it was those sorts of things. So part of the service that we offer at Inngot to an IP lender is monitoring of the IP, I should say, during the loan life. And part of that, not all of that, but part of that is to keep a list up to date, which we create at the time the loan is made. So right from the start, of the most likely buyers of the IP at the outset. And we've derived that from looking at what the company's doing, who its competitors are, how it works, where, and there's a lot of work that goes on with the assets in the background to see where the crossovers are. So a lender, if it needs to, grab for the fire handle if a loan has gone wrong and needs to sell the assets, know straight away who to go to. Most likely it's going to be a trade buyer that buys these things. So I've said it before, but analysts see an accumulated set of losses in the P&L reserve with no real offsetting asset, and they just assume the company has frittered its equity away on nothing really. And then they move on to the next prospect and find something that they can understand with a property or something, and then they probably find that that property's got a charge over it already, so they can't use it for secured lending. So that's kind of what's going on.
So how do banks now identify IP that they would consider bankable?
Well, I mean, there's a couple of ways to answer that. I mean, they can do the initial work, obviously, for themselves, and the clues are there if they know where to look. And by the way, this is something that we offer training in for a bank if they're interested. Small plug there for Inngot. But the clues are there. There's the R&D tax credits. If the company's been spending on R&D tax credits, it's been developing something. The clue's in the name of R&D. Have they got an innovative position built on their innovation? So an innovative position, seemingly producing solid or growing revenues from thin air. Where are they coming from? Nothing is better, obviously, and any bank should know this, but nothing is better speaking to the client in the first instance and asking them what they've created and how they've created. And banks do that sort of stuff if they think it's worthwhile. And what I am saying is, yes, it's going to be worthwhile. The company's probably not going to have words itself for its full IP suite. It will know bits of it, but it probably won't have thought of it all. And so what's important is to accurately identify the assets for analysis and subsequent setting of security charges that the company would have. And that's where we can help, because we have a free tool for that, which is what we essentially creates a profile, something we call Goldseam. So let us help you find this stuff. You can send, as a bank, you can send us the prospect, the company that you want. You've had that conversation. Let us tell you exactly what the assets are. And I can almost guarantee that the company itself won't know what all of those assets are. It will know some of them. IP and intangible assets can take many forms if they're bankable. It depends partly on the sector, it depends a lot on the company, but there's things like trademarks, their own software that they've developed, and it's got to be their own software, obviously. Minor rights to bases, etc., contracts, all these things can be used. Sometimes even patents, because everybody wants to think it's just patents and so on. That's why I'm putting that on as a sort of deliberately putting that on as an afterthought. Patents aren't the absolute be-all and end-all in IP lending. They're great for things like advanced manufacturing, but if you haven't got patents, doesn't mean you haven't got IP. That's a very important point to make. But basically, any of these assets that we're talking about have got to be directly revenue generating and not a speculative side project. That's probably pretty obvious, but it's worth saying. Banks, quite rightly, are looking for IP that's generating revenues. Once those assets have been identified, with us in our process, which is tried and tested, a number of banks use it, the client then pays for and will complete something we call Solomon, which is just a trading name for the valuation engine. That will give a number of different values and valuations, and I can talk about those if you wish, but I suspect you probably don't want to fall asleep right now, so I won't. And that will give a conservative bankable value because the way we combine them. And the importance is that's a conservative valuation. It's not a sort of a very speculative valuation, because that is not of any help to a bank if we did that.
Fantastic. So if a bank is going to lend against IP, then it doesn't matter that the IP is not generally represented in the financial statements.
Not at all.
Correct.
I mean, as what I was saying just now, there's a good chance it won't be represented at all as an asset in the financial statements. It will have left that sort of slightly ghostly footprint of accumulated losses or accumulated costs, perhaps is a better way of putting it. But it probably won't be represented at all. It might be, and if it is represented for the reasons I said earlier on, it will be at cost that's then further been amortized, so it won't be a very helpful number. Essentially, that's what we do. We assess the IP in terms of the value it brings to cash flows and its likely value in terms of a stress scenario further down the line if the bank has lent money to it and it needs to start thinking about what its security is worth. Obviously, those are things you need to think about up front. I said just now about how the bank approaches its risk management, how it approaches its pricing for the loan. There are strong clues that IP is there and generating value, but it's not the full story. And that's why you need a company like us to come along and exactly point out where those values are. And that's what we're here to do. We're here to help lenders.
Great. So from a company's perspective who are looking for an IP loan, what questions are the bank going to be asking about the company's IP and then the financials? What can they
Well,
expect?
sort of questions that I think could be asked in no particular order is, are you innovative? Do you have a niche? Do you have an economic moat? In other words, you're not just copying somebody else in a slightly lazy way, because that's not what we're looking for. We're looking for someone who's innovated and got that niche. Um, do you own creations of the mind, things that you've created out of your employees' heads or founders' heads? Have you built your own software? Or are you using somebody else's? Again, that's not what we're looking for, the latter one. If they're using somebody else's, we're looking for stuff they've created themselves. What have you been spending that money on? Keep coming back to that point, but that ghostly footprint that's sitting there in the reserves, what have you been spending that money on? Have you been claiming R&D tax credits? Again, all those sorts of things give you those clues that you would be looking for. And you'll be surprised how many growing SMEs fit those basic criteria that I've said. That makes them worth looking at more closely to see if there's something to be done.
Brilliant. So, from a cost perspective, then, how does this whole approach sit in the market, in the wider landscape?
Ryan, I'm really glad you asked me that question, because that is very much what Inngot has been founded on. We did a lot of research going back anything up to 20 years here, and we fundamentally found that the issue why IP finance wasn't in the market was, well, there were two issues basically, but one of them was cost. Um, for most companies, if Ingot wasn't here, if you want to find out what your IP is worth, you have to go and spend a lot of money, anything up to 5, 10, 15,000 pounds, that sort of amount anyway, to get someone to do an expensive valuation for you, which is actually looking at it probably through an equity lens, which is quite an upbeat valuation, not particularly helpful for lending. IP valuation is very, very context specific. So what we set up to do is to do these valuations that are consistent, repeatable, reliable, which is what banks need, but also to do it at low cost, which is what the borrower needs, because they're not going to spend a lot of money if they're not sure they're not going to get a loan. So we believe, I would be happy to, if somebody came along and told me I was wrong here, but we believe we have the lowest cost approach in the market, but that doesn't imply a poor approach. What it tells you is that we've spent multi-millions of pounds building our tools up to produce a scalable system, so any number of people can come to us. And the proof of the pudding is in the eating. Banks certainly like it. Look at NatWest, they use us.
Hmm. Yeah, fantastic. Yeah. So, from a company's perspective, then, if I'm a CFO or a director, or a member of the board, for example, how do investors respond to the company pledging its IP as security?
Sometimes, and a few times, to be fair, we found initial skepticism. Now, we can overcome that. We've always been able to overcome that. I think the reason there's that skepticism, I don't think, I know actually, but the reason that skepticism is there is the board or even the investor behind it can think what this means, the IP loan means is they're giving up the IP, they're giving up ownership, control of the IP entirely. Well, that's not the case. Not the case so long as they continue to make the loan payments, of course. But assuming that's the case, they still own their IP, they still have full control over it, they still should be spending more money on it, which is really the fundamental point of the loan, of course, and they can do that happy in the knowledge that it's still theirs, everything comes back to them. But we do find this actually from some relatively sophisticated financial market operators who think what they're being asked to do is to give up that legal ownership and rights to their IP right from the start, the beginning of the loan, and that's just not the case. And what we do is we talk to them and we reassure them, and they understand what's going on.
Fantastic. So, how do you reassure the board then that this is worth doing?
Well, obviously, what they get out the back of it, and you would only do something if you're going to get something. What they get out of the back of it is what they desperately need, which is funding. I could point to you any amount of research that says companies need funding. That's a given. But what do they have to give up? They are giving up that charge over their IP assets. They're not giving up the ownership, as I just said. But they should be used to security charges because not all, most companies have got some sort of security charge. If you look on Companies House, you can see that. We all do it for our own benefit in the personal basis for a mortgage. Buy a house, you have a mortgage, you give up the security on the asset that you bought. So, there's nothing unusual about that. We retain ownership, as I said just now, so long as the loan performs, we retain the ownership. And what it fundamentally does is unlocks the investment that they've made to date to allow them to use that for more growth in the future. It drives that, leverages that growth for the future. What also, it's really worth making the point about here as well, is the IP loan is a 3 or 4 year loan. That is long-term committed funding. The funding is there and there's a period to pay it back. It's not very short-term working capital type funding like, say, an overdraft or invoice financing. I don't think many people will really argue with this if they thought about it hard enough. I don't think those short-term facilities, like I say, invoice financing, which will fluctuate, of course, with revenues, is a good way of funding a long-term investment program. It's how you can get into trouble, because if you've got long-term commitments and your borrowing under your invoice financing falls because, let's just say, revenues have taken a temporary dip, they do, then you are quite quickly potentially getting into difficulties.
Yes. Okay. So let's just talk about how most people view IP, which is normally a legal construct, like a trademark or a patent or copyright protection, for example. But this suggests it's more of a business / like commercial asset, correct?
That's correct. Yes. I mean, there is a legal construct around registered rights, anyway. Let's just be very clear about that. But there is a legal construct around that. But to view IP in totality, solely as a legal construct is defensive thinking. And it's sort of thinking of IP as just a cost center and one of those nuisance things that you've just got to spend money on. Instead, what we're saying is think of the IP as the value driver that it is. It's a P&L on its own. That defensive thinking of thinking it just as a cost center and one of those things, I think is coming from a tendency for people to think of this as it's just about patents and that's all it is, because that's a legally defensive point. And I think that just sort of swims across. But there we are. That's me trying to be a psychiatrist when I'm really quite not qualified to be one. But there we go.
Okay. So do boards need to be worried about IP risk when going down this funding route? Is there insurances and things like that they can take out?
They need to be worried about IP risk regardless of what they do. If they don't even think about taking any funding out for what, that's fine. That's their choice. But they still need to be worried about IP risk because it's real, it's there, and it's probably the fundamental of their company. Yes. So how would they think about that outside of the funding? Here, they could think about things like insurance and cyber insurance. I only have to look at someone like JLR just because they're in the news at the moment. I'm not picking on them, but cyber risk is real and it's big and it's massive. There's also, for smaller companies, there's things like key man insurance if you're reliant on one or two men or women, obviously, that's just what it's called. To be frank, doing nothing is a decision. Ignoring it is a bigger risk to make than actually addressing it. And boards should be doing it. It should be on their IP should be on their risk registers.
Okay, fantastic. So not doing anything with your IP is also a risk, correct?
Correct. Yes, it is in most walks of life. Actually, think of it. To do nothing is a decision.
Yeah, of course. Right. Okay. So it's much more prudent from the company's perspective to actually look at the IP as something that they should be doing something with and using and leveraging, rather than not doing anything with it, which is actually, in hindsight, more of a risk. Yeah.
At least considering it and coming to a considered decision why you might not do something. That's important. And as I say, it should be on the risk register. That's for sure.
Great. So let's talk about the IP finance side of things and the IP loans that we've seen then. What about personal risk?
I think what you're referring to there is personal guarantees, PGs. if I could
I
just
may
call them
well
that.
be.
That is what you meant, wasn't it? Yeah. Okay. PGs, for those who don't know, and I'm sure there's not many of them watching this, but for those who don't know, PGs are exactly what they say on the tin. They are a guarantee of a loan from an individual. And kind of when you think about it, corporate is set up to sort of, to break personal liability. So, you're a shareholder, you own a company and it goes insolvent, you are not personally liable. It's the company, it's a body corporate, it's a separate thing. And that's the principle of corporates and the legality around it. But when you think about it, what a PG does is it punches right through that and makes an individual even liable for a company. And that's quite a dangerous thing. That's, I won't say it's open-ended liability. It will be capped, but it's significant liability. Could lose your house type thing. Now, the way most small companies that don't have assets, all those things I talked about before, have been able to obtain any funding, generally, I'm generalizing again, but it's broadly right, is to have somebody issue them a PG, usually a number of the directors or somebody with a great vested interest, and they're putting their house on the line, to put it bluntly. Now, nobody likes doing that, so there's your personal risk that you brought in, which shouldn't be there really. And to be honest, lenders don't like them either because there's a whole lot of reputation risk. So, but if you look, any sort of small company secured loan is usually based around PGs, actually, and that's just not good. So, why not use your IP, which is the value driver of your company, and get it away from personal risk? Because personal risk and corporates, to me, don't mix together terribly well.
Hmm. Of course, yeah, absolutely. So it's one of the benefits of IP finance, right? Is that the likelihood is you won't have any personal risk attached to it. The risk is on the IP asset, and the security is on the IP asset, correct?
It's a massive benefit. Yeah, I mean,
Yeah.
it's huge when you stop to think about it. Gav said it before. You're breaking that personal liability away from corporate liability, and the two should be separate. It's what corporate law is formed on.
Okay, so what's the catch then in IP finance?
Well, there isn't a catch in terms of, I think what you're implying, that there's some hidden thing in this that is going to trap somebody out. There is risk in any there's risk in any activity whatsoever that we do. Of course, there's uncertainty, which is how I define risk, but there is risk in terms of financing and funding. There's risk in terms of equity financing, which is how most of it is done. So it would be churlish to think that there wasn't, but debt is a sensible method for funding in the right proportions. I mean, you can go into finance theory. I won't, but equity and debt have got a sensible mix according to the type of company, according to the stage it's at, according to the sector, all those sorts of things. In the right proportions is the right qualification to make on. Debt has a bad connotation because of abuse. And if we think back to the financial crisis from however many years ago, that was 20 years ago, that was debt getting out of control. And I'm not suggesting that should happen here. We're not talking about leveraging a company up to the hill and then letting it go, sort of thing. That is clearly not what we're doing here. We're talking about a moderate, sensible level of debt to be used to bring the company into faster growth. I said before that, yes, the IP has got a fixed charge over it, just the same as if you buy a house, mortgage. People understand that. There's nothing difficult to understand about that, I don't think, if you think of it in those terms. But there's no catch per se. There's nothing hidden behind it. There aren't things like warrants and those sorts of things which can appear. There aren't the massively sky-high, stupid levels of debt margins that you see on some lenders, and way up in the teens or whatever. Than that, there isn't that catch. Fundamentally, it's allowing further growth. Everybody's happy.
Great. So I think we've seen roughly sort of 3% above base rate as the average for the IP finance products from NatWest, correct?
Yes, I mean, we're not supposed to talk about margins and costs and things like that, but NatWest have put it out into the public domain very helpfully. So we can say that on average, the portfolio of IP loans that we collectively have done so far, the margin is coming in round about the 3% mark, some above, some below, that sort of thing, coming in round about the 3% mark, which is a sensible level of margin for a growing company to pay. Well, again, I just say the same thing as I said just now. We're not talking about in the teens.
Great. So if we just move on to talk a little bit about the market then, why are banks and insurers viewing this market differently today compared to 5 or 10 years ago? What's prompted the change?
They're having to think differently. I mean, banks need to keep a loan book. They ideally want to keep that growing, that loan book, get market share, do all that sort of things. I talked about just now the economy having changed, and you can look back in the ONS data, which I think the ONS will admit is slightly flawed, but it's basically, right. Intangible spending in the economy has been exceeding tangible spending, I think, since 2003. Correct me afterwards if I'm wrong, but it's about then. So that means companies are spending much more money essentially on intangibles than tangibles. So there are fewer tangible assets to go around. Those that do exist, because of the bank's traditional views, which I've talked about already, means most of those tangible assets have got security over them anyway for smaller companies. I'm clearly talking about here. So there's a smaller and smaller and smaller pool of assets for them to get hold of in security terms. So they're having to think about what else is it. What they are also waking up to is the point I made about IP is actually driving these companies' values. If you manage to sort of get some sort of tangible asset there and take that security, if you manage that as a lender, it's not front and center to driving the values and driving the cash flows. It's a bit removed. It's something they just have. So why not put that security over what is actually driving it? Basically, this is a way of getting funding into growth markets. You will have seen that in a couple of announcements in 2025, I was going to say this year, but 2025, the UK government has made points of IP finance needs to be explored further. In actual fact, it's becoming quite urgent, and that is because the government has realised IP is the way and intangibles is the way to get funding into small growth companies. So, everybody's realizing it. We're seeing this abroad as well, and particularly in Asia. I mean, it's they're ahead of us on this, to be honest with you. And companies are saying it. We're seeing it in the EU as well. There's a number of countries saying that, we've got to get funding in. The only way we can do it really is IP.
So what makes this a credible funding option now where it wasn't 5 or 10 years ago? Is it like cost of IP valuations, that type of thing?
Yes, I mean, that's one part of it. And I think we rightly should take most of the credit, if not all of the credit for that. But also there's a better understanding. The British Business Bank, the BBB, published some really helpful data back in 2018, which still stands today. And that was looking at default rates across a very large portfolio of admittedly smaller companies under their enterprise finance guarantee as it was at the time. And I think there was a sample size of something like 23,000, but it was very large, which showed that the presence of decent IP, how they defined it, to put it crudely, it kind of halved the default rate and it improved the expected loss, the two parts that I referred to at the beginning of risk. So that's helped. That's put it out there. The cost of IP valuation, as you just said, which we do at a fixed price. There's, if it was the biggest company in the world came to us, or whether it's the smallest company in the world, still going to charge them the same price for our valuation through the tools. There's the shift in policy that I've just mentioned, the government's modern industrial strategy, which is talking about IP finance. That's waking people up. There's the entrepreneurship prospectus they launched. That's waking people up. And it's becoming more prominent in news and business, and it's becoming harder and harder to ignore in real insolvencies what actually gets bought out. I know I've mentioned that before, but it's hard to ignore that. Fundamentally, if the economy is going to grow, we need to get growth funding in there, and the way that's going to happen is for IP for smaller companies.
Fantastic. So I think we'll wrap it up there, but if there's one thing you'd want CFOs or businesses to understand about IP-backed funding, what would it be?
It's real, it's available, and it's becoming increasingly mainstream. That means it's not exotic. It's not some sort of very, esoteric, fancy thing that's got all sorts of, it's hard to understand. It's not actually. It's not expensive. It's available even from trusted sources. I'm talking about NatWest. HSBC uses it to a point as well, in a slightly different way, but they use it as well. They're awake to it as well. It's available in affordable loan sizes. There's another point to make. The IP loan goes down to 250,000, which isn't a lot of money, and that then in itself is an interesting point that it's available in such a small amount, because that shows you how low we've got the costs of actually, making a loan available, which is partly down to us, and partly down to our friends at Aston and the like. It's available to scale ups, and I think that's probably what I want to say. The other thing that's all talking about, the availability, the supply as well. But our friends at places like the CFO Centre. I mean, CFOs from the CFO Centre have used it. We've got a couple of deals with from CFOs from that organisations as sensible, grown up, and widespread, and all those sorts of good words. Are understanding it and using it as well. So all of that is great. So don't be afraid of it.
Great, yeah. So it's really available to the masses now, whereas IP was such this out of reach product because of the cost of IP evaluations and the size of the deals, but it's now available to the startups, scale ups, really.
Yes, it is. That's absolutely right. And it is worth just reiterating, just to be absolutely clear for anyone watching this, it is worth reiterating that startups, and by startups I mean companies that aren't really generating revenue yet, are too early for the loan. It should be pretty obvious, but they are too early for the loan today.
So they're equity at that stage.
Yes, they are an equity risk.
Yeah.
Today's startups are tomorrow's scale-ups. So we were happy to speak to them, but there isn't a loan available for them today. So I don't want to make sort of, imply false promises or anything.
No, so it's that stage where they're starting to really grow, generate revenues from their IP, allowing them to scale further, and just leveraging those assets that they built and spend a lot of time or money sometimes building to grow further.
It is possible as well, and we have done it with NatWest. It is possible to fund companies who are still loss-making at the operating level, because what they're doing is spending the money where they should be spending it, and creating those ghostly losses on developing their IP further.
Fantastic. Thank you, James.
That's quite all right. Thank you for the opportunity for letting me speak to you, Ryan.